Okay, good afternoon. It's a pleasure to be here. I just want to start out first by saying you may have invited the wrong person from my family here. My wife is an oncologist at Memorial Sloan Kettering in New York. She studies low-grade serous ovarian cancer. She also did her residency at Mass General, her internal medicine residency. When I told her I was coming here, she said, what are they asking you there for? I said, I don't know. We'll go find out. But anyway, so there's certainly, I would say, a lot of this conversation that goes on in our household as well on different levels. I'd also like to say I'm joined with my distinguished panel of expert economists. This is the number of economists who correctly predicted the last recession in the United States. It's probably also the number of economists that you invited to your last block party. I get it, we're not always the most interesting people. What I would like to do is give some thoughts here on the U.S. economic outlook. The title is essentially Good News is Bad News. That's an idea of the stronger the economy is, the more rate hikes it's going to bring, the more consternation the last panel providing capital to the industry may have. But it is just general backdrop, which I think you're all, I'd say, familiar with and comfortable with. When we were heading into the pandemic, the role of policy essentially said we should hope for the best but prepare for the worst. So we put a lot of fiscal and monetary policy into place, a lot of federal spending, a lot of federal transfers to households. We took on a lot of treasury debt in order to do that. So the Fed kept interest rates low, bought a lot of securities. We flooded the zone with money. Interest rates were low. Availability of capital was high. We essentially wanted to keep the wheels of the financial market going during a very uncertain period. That did two good things and I think one bad thing. The two good things are, first, it prevented an even larger downdraft in activity. Now that may sound odd given that the economy contracted at about a 25% annualized rate in early 2000, but in essence, it did help prevent a larger downturn. The second thing it did is when the economy ultimately reopened in a gradual and sometimes halting fashion, it meant there were a lot of resources on household balance sheets and corporate sector balance sheets to re-engage in activity, to rotate away from goods spending over to services spending, and it generated a tremendous amount of reemployment. We're a very large, generally internally focused, services-driven economy. You can't increase services output without adding a lot of employment. So it only took about 3 years to recover all of the lost employment during COVID. If you contrast that to 2008, 2009, it took almost a decade to recover all of that lost employment. So the good news, not as much of a downdraft in activity and a much quicker reacceleration in the economy once the doors reopened. So we did get something closer to the best, at least what epidemiologists would suggest, and economic activity recovered quickly. The bad news, of course, is it gave us a lot of inflation. And the Fed was probably a little too complacent in letting inflationary pressures build, thinking that it would ultimately be transitory and short-lived and inflation would come down quickly. And honestly, we haven't had inflation like this in 4 decades. So now we're at a point where over the last year, the Fed said, oh, okay, fine, it's not transitory, may ultimately be temporary. It's our job to make sure that it's temporary. So we embark on a series of fast and large rate hikes, again, like we haven't seen in about 4 decades. So the question I am asked to answer for our clients of Bank of America and for you in this room is essentially, well, where does this all go? Where does this all end up? Typically when the Fed does this in the past, we've had some sort of dreaded recession or there are economic implications. So where is this going? And again, the number of people who generally get this outcome right and predict it correctly and accurately in real time. So we'll see. So I would say if we take a look here at, well, what can we say is happening? So the Fed's raised rates a lot. The cyclical side of the economy is responding. The chart here on the left is one of a new home sales chart for housing. Housing's trying to find a bottom. Still very strong demand in the housing market, but really not a lot of supply. So housing is hit with an affordability shock. Home prices nationally are up about 40 to 50% since early 2020, and now mortgage rates are about 7%. So demand and the ability to afford housing is certainly down. The chart on the right is housing starts and building permits. So this is not only what I'm starting, but what I also anticipate to start. And the chart on the left is the affordability index. So we had a long decade of very high affordability in housing, and that's turned the other direction. If we go to existing home sales, that's the chart on the left, we were turning homes over at about a 5 million annualized pace before COVID. We're down at about 4 million. So we're transacting about a million fewer homes on average if we kept this run rate over the course of the year. So housing is responding. It's a cyclically sensitive sector. It's, I'd say it's in a recession, but it's not really in bad straits. There's plenty of demand for housing. There's just no supply. Virtually all mortgages out there that have been issued over the last decade are below 7%. So nobody wants to move. Nobody moves unless they have to. Somebody described housing to me as it's like Han Solo frozen in carbonite. It just instantly stopped. And so I think is a pretty good description. But housing certainly has slowed down. It's probably the most interest rate sensitive sector of the economy. Then I would say we came into late last year, November, December, and manufacturing started to slow down. I think as we all know, during the pandemic, we had to set up multiple offices and we, hand over fist, we were buying goods. We were not going out and eating at restaurants, getting on airplanes, staying in hotels. Services consumption fell. Demand for goods was extremely strong. And there were shortages even through most of 2022. So backlogs were really high. You probably have many stories of things you wanted to buy but couldn't get it for about 8 to 9 months. So manufacturing was really clicking. And here what you're looking at are industrial production statistics on manufacturing. You see the big rebound following COVID, about as strong as it was following the global financial crisis 08-09 in terms of when the economy expanded and manufacturing production finally recovered. So it was as good as it ever really was, and it's come back off of that. Because in the pandemic, of course, when pandemics ended, spending rotates back to services, goods demand is generally satiated, inventories recover, so the producer says, I'm good. My customer has a lot of inventory, demand has come down, so manufacturing production starts to slow. Again, it's a cyclically sensitive part of the economy. You think autos, you think other household furnishings, anything that needs to be bought on credit is likely seeing less demand and a more normalized inventory situation. So, okay, let's check the box on housing, and let's check the box on manufacturing. So then we turn the calendar year, and there's a really strong employment report. We added about 500,000 workers in January. Spending in January was up about, I think it was 3%, sorry. Retail sales were up 3% on the month alone, so annualized 36% rate. And we were all like, oh my gosh, is the economy re-accelerating again? We were skeptical, and we were saying, no, watch out. It looks to us, this is the chart on the left here, is the net percentage of banks that are tightening lending standards. And this particular series shows to consumers. Credit card debt, auto loans, other credit. This chart on the left shows the net percentage of banks that are tightening loans on what we call commercial and industrial loans or loans to corporates. So you can see basically 2 to 1 banks are tightening standards. We're like, doesn't seem like the economy is going to reaccelerate. And we have regional bank stress, and we have 3 large bank failures in March. So we would say, yeah, Fed policy is working the way that it's intended to work. The way the Fed slows the economy down, one of the primary channels is through the lending market. So borrowing rates go up, the cost of capital goes up, profitability for banks go down. In theory, actual capital approaches the regulatory minimum and banks slow loan growth. What you heard in the last segment was also, it gets really challenging to finance new opportunities on a venture capital basis or a private equity basis. It gets a lot harder to take firms from private status to public status. This is what monetary policy is supposed to do. It's supposed to make it harder to get things on credit. It's supposed to make it harder to get funding for new operations. It's not a thing the Fed loves to do, but the point is we need to moderate demand to help bring inflation down. So whether it's the banking sector or capital markets, it's getting a lot harder to fund the things that this room is relying on, and the outlook there is more difficult. And loan growth has definitely slowed. It's hard to see it on this chart, but there's essentially kind of 4 basic loan categories that one can track. C&I loans or loans to business, commercial real estate loans. That can be for multifamily residential properties, but it can be also for things like office space, brick and mortar retail, and parts in warehousing like Amazon building warehouses. So some of that market is doing just fine, but things like office space and work from home, that's a challenge. And retail brick and mortar has been an issue for well over a decade now. But loan growth to firms is actually negative in terms of growth rates. In nominal terms is negative. And loans into the CRE, the commercial real estate sector, is basically flat in real terms, so negative in inflation adjusted terms. So definitely lending is slowing down. To the consumer, however, lending is still pretty robust. And lending into the private residential mortgage market, the housing market, is still pretty robust. So it's a mixed picture. If you were worried that a couple regional bank failures meant a return to bank crises like we had in 08, 09, I think the answer to that right now is no. But certainly that's a risk that we need to continue to monitor. There's a fine line between, hey, we're supposed to tighten policy by raising interest rates. That's supposed to slow loan growth. Yes, that makes it difficult for banks and other capital market institutions, but that's our job. We're trying to slow the economy. There's a fine line between that and putting too much pressure on banks, and there's unknown exposures in the banking system, and you get defaults, and you get bank runs like we had, and you get crisis situations. The risk there is, of course, you get a much stronger and sharper pullback in lending activity and the availability of capital for venture capital and PE and bringing firms to market, that you miscalibrate, you tighten too much, risks are exposed, you get a credit contraction, and then you get your so-called hard landing, where the economy rolls over much more quickly. That was the fear that came up in March. I would say the evolution of it, and I won't go through the whole story on how I generate this chart, just take it for granted that I kind of know what I'm doing in this one, and say, are we getting excess tightening? Are banks behaving more cautiously than we would expect, given that the Fed is tightening policy, given that the economy is slowing? The answer is yes, but it's only a little more than normal. So I think the answer would be yes, there's stress in the regional banking system, there's certainly stress in capital markets, but is it out of line with what the Fed and policymakers would expect, given a fairly rapid and sharp tightening cycle? I think the answer there is no. And the broader data actually supports the idea that the economy is doing okay in a world where loan growth is slowing, and the Fed is tightening policy. So as I mentioned, the reopening of the U.S. economy has led to substantial reemployment. This chart here on the right is employment, either in the establishment survey or the household survey, indexed to February 2020. So when you cross the dotted line is when employment has returned and recovered all the way back to February 2020 levels. And you can see we're now kind of powering above where we were in February of 2020. Economists often refer to what we call the virtuous cycle in an expansion. And it's as simple as saying, well, the economy reopens, households spend, they rotate demand over to services. That means employment picks up, but that also means labor markets income grows, which means demand accelerates even more, which means hiring picks up even more. And because we're this kind of internally focused, domestically oriented services economy, we're not dependent on global growth. We're one of the few countries that basically generates its own internal growth, and the rest of the world is still dependent on what happens in the US economy. We're not completely immune from the global market, that's for sure. But in an expansion phase, in a recovery phase, especially when spending's rotating to services, this is what we do. This is our sweet spot. And so the momentum in the US economy, the virtuous cycle has been strong. We still added 339,000 jobs last month, and there were about 95,000 upward revisions to the prior 2 months. So on net, almost 450,000 new jobs. In an average recovery, we're pounding the table excited if we're adding 200 to 225,000 jobs. So even this far after the tentacles of the darkest days of COVID, we're still adding jobs at a fairly rapid rate. Again, that's creating momentum when it comes to labor market income, employment, and overall demand. What I'd argue, though, is that momentum is getting narrower. So there are some signs of cooling, and maybe we shouldn't get confused by, say, the overall absolute level of employment growth. The way that I show that here is that the chart on the left, this is the monthly change in services employment. Again, it should be decelerating. Obviously, we're not going to keep adding 500,000 jobs a month. Reemployment runs its course over time. The dark blue lines, though, is what I'll call loosely employment in your industry, which includes employment in your industry. Leisure and hospitality, education, and health. Obviously, health is covering the group in this room to a large degree. These are the last of the catch-up sectors. These are the face-to-face, service-oriented jobs, largely, that people didn't want to do either because working conditions weren't great, they had fears of COVID, or pay wasn't exactly there. So you can see employment gains in that sector, the dark blue bars on the left, that's been pretty consistent, that's been pretty steady. But as you can see in the chart on the right, it's now accounting for about 67%, or 2 out of every 3 jobs added in the private sector. Every other service sector, which is the light blue bar on the left, you can see the growth rate there has really come down. So this is where there's a balance between saying, sure, 339,000 jobs, massive employment numbers, but the breadth of that employment growth is narrowing. The catch-up effect, getting all sectors back to February 2020 levels, is ending. So when we think of when we think of employment in healthcare, I think we all know that there's been a lot of labor shortages in the industry, and there's still some labor shortages. Nursing and residential care facilities, for example, employment's still 10% below February 2020 levels. In what I think would be employment more closely related to this room, scientific research and development, 23% above February 2020 levels. So very mixed performance, and still areas where employment shortfalls are persistent. The other thing I would argue is that we need to remind ourselves that employment is hard. Employees are hard to get at this point in time. There are still some shortages. Firms may be doing what we call labor hoarding, where it's been hard to get people in the door and get to fill certain spots, so I'm not going to be too quick to let them go if things are slowing down. This is probably more the case outside of leisure and hospitality, education, and health. Let's call it the non-service sectors. The areas of the economy that did well during the pandemic in terms of employment: professional and business services, technology, finance, construction, manufacturing. When economists think of labor market income, it's not just your wage or your average hourly earning. What we think of is the product of employment, hours worked, and wages. because total income for the economy can go up if any one of those three things rises. And so if you employ more workers, work them more hours, and pay them more, which is what we had coming out of COVID, you get growth in total labor market income, like you can see here, that was exceeding 10% on an annualized basis. So there was a narrative that average hourly earnings or wages were not keeping up with inflation. And I'd argue, well, that misses the point, because if you work more hours, even if your wage didn't go up entirely consistent with inflation, your labor market income did. But what you can see in that last bar is hours worked is now actually contributing negatively to income growth. Manufacturing, as I mentioned, is weaker. Housing is weaker. Firms may be holding on to employees, but working them fewer hours. So the intensive margin may not be on bodies and seats, it may be on hours worked. So again, some early signs of cooling. Economists also love to look at things like the quits rate and the job openings rate, meaning our new openings coming online. If people are switching jobs, it tends to mean demand in the labor market is strong. There's data that pointed to these things being at fantastically high levels coming out of COVID, but they're slipping. They're moving back towards more normal levels. The quits rate here is on the left. The openings rate, the number of job openings is on the right. So maybe the unemployment rate hasn't moved up. It's still 3.7%, multi-decade lows. But again, on the margin, it seems pretty clear that the labor market is softening. But it's hard for me to stand up here and tell you that the labor market is weak. It's not weak. We've added millions to the labor market. Income growth in aggregate is still keeping up with inflation, and we added 339,000 jobs. That's going to want to push the unemployment rate lower over time, not higher. There's still imbalances in the labor market. So on a first order effect, about as tight of a labor market as we've had still to this date in 3 to 4 decades, probably closer to 5 decades. And it's hard to, but on a second derivative basis, it's slowing down, but only gradually. The other thing that's keeping the economy very resilient and spending strong, and people like me thinking, well, maybe the Fed has more work to do to slow the economy down and bring inflation down, is this concept of excess saving. Where, as I mentioned earlier, the government flooded the zone with resources. There were a lot of transfers to households, and there was a lot of credit provision to corporates. Now we try and develop a measure of excess saving, take this with a grain of salt, because it starts with where would the pool of saving in the economy be absent a pandemic? But you can get an idea here if you look at the chart on the left. This is personal income. You can see the massive spikes there's 3 massive spikes that correspond to the 3 big fiscal bills and the transfer of resources from the government sector to the household sector. And what that did, in the chart on the right, the light blue bars are the monthly change in excess saving, and the dark blue line is the level of excess saving. It put about over $2 trillion in just liquid financial deposits on household balance sheets. And you can see during COVID, what did we do? We built those up. Some of that was because we couldn't spend, so deferred consumption. Some of this was government transfers. And again, we couldn't spend it when we got it, but when the economy reopened pretty strongly in 2021, the light blue lines start to turn negative. You start to draw down on that excess saving. Again, this is in addition to the labor market income that you're generating, which is growing more rapidly. So households in an environment where inflation goes up, you get a shock to your real income. What do? You draw down on your resources and you keep spending. So this is the legacy of fiscal stimulus still sitting on household balance sheets. We estimate it's still around $700 billion or so. As you can see, it's falling at about $70 billion a month, which means we could have resources to kind of keep supporting spending through the end of this year, but it's getting depleted. There's less kind of room for excess saving to support consumption. And some will argue, well, come on, Mike, we all know that excess saving isn't evenly distributed in the economy. It's generally sitting on upper income balance sheets. That's true. Probably 65, 70% of this number is sitting in the top quintile of household balance sheets. So plenty of households are still kind of living paycheck to paycheck, and we shouldn't think that everybody is in this situation. But what I was reminding people of is there's analysis done by the Bureau of Economic Analysis, the people who should know, and about 80% of spending in recreation and leisure and hospitality comes from the top 20% of households. So I would argue from a recovery and a strength of the recovery perspective, excess saving is sitting exactly on the balance sheets of the households that are going to spend it. The carry through to the rest of the economy is through employment. So again, this is helping to fuel the virtuous cycle, continuing to expand services output. Everybody, I think, that has gotten on planes in the last 6 months knows everyone is absolutely full. They were giving away $1,000 vouchers for my little shuttle from New York to Boston this morning for 3 people who would step aside and take a later flight. Every plane's packed, hotels are packed, every restaurant's packed. You've seen it, and I think you feel it. But so excess saving is supporting that virtuous cycle. The other thing I would point to, is wealth effects, right? When economists are thinking about what's the average consumer going to do? How are they going to spend? The starting point in our analysis, well, tell me about their balance sheet. Tell me about their assets and their liabilities. So here we're thinking financial wealth and real estate wealth, and how much do they owe on those things? What's their mortgage? What are their other liabilities? The difference between that, of course, is net worth. And the higher your net worth, the more out of your current income you're willing to spend. In other words, the lower your saving rate. And here I'm showing the 4-quarter change in the asset side of household balance sheets. That's the dark blue line. And the light blue line is the 4-quarter change in household liabilities. Just trust me that I can extend this series back to 1960, and the blip there at the end is about 5 to 6 times bigger than any spike in household net worth that we've seen really kind of in the history of the post-World War II US economy. So I'm going to try and let this statistic sink in. Household net worth from trough to peak rose by $33 trillion during COVID. That's more than 1 year's worth of GDP. So again, when you're thinking of the strength of the labor market, when you're thinking of the pile of excess saving, and we're thinking of the wealth position of the average household, everything says resiliency in the economy. That's why the Fed's been raising rates to 5% and is probably going to consider going higher, and the economy still isn't quite slowing down. So it's really tough to slow down an economy that's reopening from a pandemic, swinging to its sweet spot, creating internally generated growth, fueled by past fiscal transfers and an explosion in home prices and financial market valuations. It's a tough game for the Fed to kind of get this one right and not over-tighten too much, but not under-tighten, and let inflationary pressures stay uncomfortably high. A few things I'd just like to make comments about that rotation to services spending. Again, the recovery in all sectors has not been even. This is the chart on the right is spending in some selected very broad services categories indexed to February 2020 at 100. And as you can see, spending on healthcare really only recovered in 2022 in many cases. And in part, like transportation still hasn't recovered. The fact that we're all spending maybe 25 to 30% of our hours on average across the economy still working from home means we're not commuting. So the structural shift in the labor market and the work from home, work in the office balance has meant that some of these services sectors and spending probably won't recover. There has been a structural change. But spending on recreation, spending on accommodations, those have been surging. But within healthcare, it's been tough to recover. Total healthcare spending by households, right? It returned to February 2020 levels only in August of 2022. Outpatient services and nursing home services didn't recover until the end of 2022 and early 2023. Hospital services was more like mid-2022. Again, the exception is kind of the people in this room. Medical laboratories rose immediately above February 2020 levels and hasn't slowed down. So we're all still out there getting our blood tests, and we're all still out spending on laboratory services. It's about 25% still above pre-pandemic levels. So again, healthcare, to me, it's been a bit of a conundrum. If the balance sheets of your institutions have been slow to recover, it's in part because household spending has been slow to come back in this area, although certainly it's been uneven. I think we'll get there basically for everything but transportation, but it's been a longer, tougher slog for parts of the services sector than I anticipated, particularly given the patience of the people in this room, the patience of my wife. This is not, in many cases, elective type of surgery or care, and I'm surprised at how long it took for spending on healthcare to recover. In terms of the story on labor shortages, if we had met 6 to 9 months ago, whoops, hold on. Where was that one? If we had met 6 to 9 months ago, I would have been much more concerned about shortages in the labor market. Or maybe I put these at the end, sorry. You got to change your slide deck around, but then you often forget exactly where you put your slide. For most of 2021, the shortfall in labor supply was about 4 million. For most of 2022, it was about 2 million. So we were constantly worried that massively high demand for labor against persistent shortfalls of labor would create more prolonged wage and inflationary pressures. Fortunately, from a supply perspective, a lot of that has now gone away. So I would have told you stories about immigration, I would have told you stories about early retirement, I would have told you stories about difficulty in getting women to return to the workforce, and a number of other things, and even just generally the matching requirements for people who want to work from home, but industries that say, well, I'm sorry, you can't have a restaurant and work from home. So there's kind of legacy issues around rebalancing the labor market and the desired type of employment that were taking time to work out. But so that gap, though, was 4 million, 2 million. As of the first half of 2023, that number's down to about 440,000. So there's been a narrative of the gamer who sits on the couch and isn't working, or the people who are getting the federal transfers and not coming back to the labor force. It's largely a myth. Most everybody is back, and including immigration in 2023. Leisure and hospitality, education and health are sectors that have historically relied on immigrant labor, and I think the fact that we've been able to add jobs at the pace that we've had corresponds and matches up with some of the data on immigration that we've seen. So that's a good news from an inflation perspective. It's a good news from a policymaker perspective, because then it means the imbalance between labor supply and labor demand is smaller, and we've actually seen inflation start to come down, even though the unemployment rate has stayed at 5-decade lows. The one exception to that is this chart on the right. It shows the participation rate. The light blue line is the participation rate for the 55 and older age group against that for younger workers. The overall participation rate is in the chart on the left. It's 1 or 2 months behind. It's actually close to pre-pandemic levels now. So that if you're 16 to 24, 25 to 54, participation has rebounded and recovered to pre-pandemic levels, largely for men and women across most industries. I'd say things are normal. What you still see is a very persistent early retirement effect, where there were people, and I think this goes back to that massive accumulation in net wealth, said, well, I was a couple years away from retirement anyway, I'm out. So if there's a shortfall in labor, it's primarily probably that early retirement number. So I'm less concerned about that, and again, from a business cycle perspective, it's much more favorable in terms of whether or not there's recession risk on the horizon. Look, so At B of A, we're, meaning Mike, people can choose to believe Mike or not, so I'll let you also have the same option, which is, yeah, I think it'll be hard to get inflation down to 2%, which is the Fed's goal, low and stable inflation. Why 2%? 2% is viewed as a rate that's low and something that most of you in this room wouldn't consider when making decisions to spend or invest. So the target should be low and stable inflation, so we can just basically remove that as a decision point from the table, whether it's household decisions or business decisions. So getting all the way back down to 2%, I think, will be hard without leaning against this labor market a bit, without leaning against consumer spending. History would say, to get the amount of disinflation we require, you probably do need at least a mild downturn. So what do we mean by mild recession or mild downturn? Well, it's probably, most of us who are in this camp of saying, yeah, you're probably going to need a couple quarters where consumption takes a break. You may get a few, you may get some layoffs. We're getting layoff announcements in those sectors like professional and business services, finance, technology. So it's popping up. Manufacturing employment levels have come down a bit. Probably half as bad as the average downturn is probably about all you need. 1 to 2 quarters, a backup in the unemployment rate to more normal levels, somewhere around the mid-4s, maybe high 4s. But I don't really know anybody who's out there saying, we got to really slam the brakes on the economy. We need a Volcker situation. That's not really where we are. For those of you in the room who are of my generation, Volcker was facing 8 to 10% inflation and 8 to 10% inflation expectations, which is a world where the central bank doesn't have credibility about achieving low inflation outcomes. So to correct that, yes, history says you need a deep recession because you have to change the mindset around inflation and you have to establish credibility. You establish that credibility by demonstrating it. We're not in that world. Inflation is high, even though this morning the year-on-year rate of core CPI decelerated to 5.3%. At the headline, it's down to 4%. But longer-run inflation expectations are still about 2%. 10-year Treasury yields around 3.75. That doesn't suggest the market or investors view the Fed as not credible. So the cost of bringing inflation down in a world where you have credibility is actually lower. And the cost of bringing inflation down in a world where labor supply has returned more strongly than even somebody like me thought 6 months ago, the cost to bring inflation down should be lower. So most of us are in the camp of maybe later this year, maybe early next year, Fed tightening will slow down the labor market, it'll slow down consumption, the unemployment rate will back up a bit. But I'm trying to remind people the policy error is not whether or not we get a recession or not this year. The policy error is whether or not we get inflation back down to low and sustainable levels. So now I grant we can have a debate, is 2 different than 3? Is 3 really different than 4? It's hard for an academic economist to come up to you and say we know with complete and 100% certainty that 2 is better than 3 or 2 is better than 4. We can certainly tell you 4 is better than 10. We can't really tell you that 2 is better than 3. But the point is, if the Fed is successful at bringing inflation down, the difficulty in financing venture capital and private equity, which was one of the main components of the last segment, that'll get a lot easier. And the outlook for the US economy on the other side of whatever we're going to get here, to me, looks quite good. So it's the long-run performance of the US economy does best in periods of low and stable inflation. So the Fed should be prepared to pay whatever cost it needs to in order to get there. Because the alternative is inflation that stays too high, credibility that ultimately maybe gets lost, you're at least risking it. Inflation expectations go higher, long-term interest rates go higher, and that's a cycle that's a lot harder to break, and history says comes with a much more painful downturn. So we should all be rooting for the Fed in this case, even though over the next 12 months it could bring some non-trivial softening in the labor market, but the goal is the right goal. It's a tough time for them right now to figure out exactly how restrictive policy rates should be, how quick they should run their balance sheet off and let securities go back into the market, and fine-tune an economy that still has reopening pressures that has legs to this day, where parts of the economy like housing, manufacturing, and some components of business spending are already kind of consistent with the downturn or recession that people like Mike think may be coming. But the other side of the economy is accounting for about 300,000 jobs a month. Labor growth or labor market income growth is still strong. Rapid reemployment, a lot of excess saving, a lot of wealth accumulation. So there's some bifurcation in the economy, and it's really tough for the Fed as a policymaker at this point. So that's really the question. How much pain is needed in order to bring inflation down? We're going to learn a lot about that over the next year. If we get some, I think it'll be much less worse than the average, unless we've totally misjudged this risk in the banking sector. And there's problems around the corner that we just don't know about. And I can't rule that out either. Fed tightening cycles often create problems that were unforeseen in advance. And I think the risk here, the risk of a hard landing is what an economist would say is the cost of low for long policy, low interest rates for a prolonged period of time, and promising low interest rates for a prolonged period of time. So in the last segment, when you heard about, wow, there's a lot more discipline now being applied, and the 220-ish IPOs that came, that wasn't good. And valuations were too high for early stage firms. And now we're paying the price for some of that. That's the cost of low for long policy. From the Fed's perspective, that's okay because it's sitting in venture capital and private equity. The risk that rolls up and creates a financial sector problem or a banking system problem like it did in 08, 09 is probably low. But it's a harder nut to crack than when you're talking about, well, what about large regional banks with over $100 billion in assets? Those are much closer, those are actually sit in the core of the financial sector that the Fed is trying to keep stable. So there's always risk that when you embark on a quick and fast tightening cycle, maybe the wave from excess saving and the reopening effects go out. And as Ben Bernanke used to say when I was on staff at the board, when the wave goes out, you always find out who's not wearing a swimsuit. And that's the risk. Otherwise, I think we're in for a world where we can soft land the economy, bring inflation down to reasonable levels, and avoid a downturn, or we get one that's fairly mild, but the good news is coming out of that is inflation will be back to more normal levels. So then I think we'd look back and say, yeah, we prepared for the worst and we hoped for the best, and we did get some inflation out of it, but we took care of that. And then I think the next 10 years for the economy look really good. I think probably the outlook for your sector looks really good. The outlook for activity in Boston, given the concurrence of universally and world-renowned educational institutions, massive teaching hospitals, biotechnology, hopefully firms like ours that are part of that process as well. It's really interesting how industries cluster in certain cities. That's certainly the case here. But I think that operation will look just as good coming out of the other side. It's just we're near-term focused on what's all this going to bring in the next 12 months in terms of recession risks. I would say we probably put way too much emphasis on the R word. The goal needs to be kind of what I'm showing here, and I'm leaving it up there for effect. I do think inflation's going to come back down, and in 2024 and 2025, it's going to be in the rearview mirror. The last vestiges of COVID in terms of its macroeconomic effects will largely be in the rearview mirror, and we'll be back to, I think, more normal cycles after that. The clock's ticking down. I've got about 1 minute and 50 seconds left. I want to keep all of you on time, of course, and I do just want to say that I'm the generalist in this session. Hopefully this has added value to you and been informative for you, but it's my pleasure to be here on behalf of Bank of America speaking with you today. I wish you the best in your conference this afternoon and tomorrow morning. So thank you very much for your time and attention.